Hello, I'm joined today by Hugh Sergeant, the manager of River and Mercantile UK Recovery Fund. Thank you very much for joining us today, Hugh.
Good to be with you this morning.
Hugh, it's very interesting times at the moment, volatile markets. I believe that's the sort of environment you like. Have you been very active with the portfolio recently?
Volatility often creates opportunities, and those are our bread and butter, I suppose. Recovery PVT opportunities, and this sort of environment is providing more opportunities. The market's obviously volatile in the context of moving away from this deflation and low interest rate environment to more reflationary, inflationary, higher interest rate environment, and that's creating a lot of uncertainty. Uncertainty equals volatility equals opportunities, but we're being gradualist, I would say. So key areas that we're looking to add more capital would be some of the consumer cyclicals that have derated aggressively, industrial cyclicals that have derated aggressively. So from our perspective, that equals an opportunity. Just in general, UK equities and many global equities, amazing value at the moment. So this portfolio, UK Recovery, is trading on only 10 times earnings. So I do see it as an exciting time in terms of buying stocks cheaply.
And I believe you've added Close Brothers recently. What is it about that stock which you like?
Yeah, we have been again gradually building a position. That's in the context of us putting more capital to work into the lenders, the banks, UK banks, domestic banks, and also the Asian banks, UK banks. We see as very attractively valued. Interest rates are going up, so their net interest margin should be able to improve in that environment, despite more favourable background. The banks have actually derated because the market's worried about the credit cycle. We actually think the credit cycle will be more relatively benign compared to previous economic downturns. So we see that as a real opportunity. Close Brothers, though it's not just a lender, it's obviously got the wealth management business and winter floods, but it's been derated, I think, in the context of worries about the UK lending environment, and we do see that as a big opportunity. And actually, if you look at the Close Brothers valuation, it trades at just around 1 times tangible book value. You have to go back to the depth of the global financial crisis for that kind of low valuation. So when things were particularly bad, Close has over the years been able to generate attractive return on capital and be far less cyclical than other lenders, and we really don't think that's reflected in a very low valuation of only 1 times book.
And what gives you that confidence that the credit cycle is going to be benign? Because everyone's got quite negative at the moment. The consumer's supposed to be struggling with inflation, higher energy prices, etc. So, there's quite a lot of nervousness out there.
Yeah, and I think that the nervousness is understandable in the context of a different regime, clearly more inflationary regime. Our own view would be we've for 2 to 3 years we've been in the reflation camp, and that low interest rates weren't going to be around forevermore. We're not in the camp of inflation getting out of control. So we do think some of the current inflationary pressures will prove to be a little bit cyclical. So those will start to peak. Our key observation on the credit cycle with respect to banks is that they haven't really been aggressive lenders over the last 10 plus years. Ever since the global financial crisis, the banks have actually essentially been pretty cautious. Often they've been required to delever, and as a result of that, they should have pretty strong credit. Their balance sheets are very strong. They've got excess capital. If you look at the Lloyd's, a lot of its lending is against housing assets, and obviously house prices have been very strong. So it's those reasons that we're actually think the credit cycle will be relatively benign, and understand the short-term pressures on the consumer, and understand why some of those consumer stocks have been derated. But we do think the actual consumer's probably in a little bit of a better position than the current real fears think. And the reasons for that is that the consumer balance sheet is strong, so they've there's been quite a significant wealth effect from house prices moving up. Employment prospects have remained very robust. And actually, there is a positive of wage inflation in that there is a little bit more cash going into the consumers' pockets, and then they obviously saved a lot during lockdown, and not all that saving has been spent. So I think they're just in a little bit better position than current very, very gloomy consensus assumes.
Yeah, and I believe you're getting interested in real estate stocks at the moment. Is that real estate investment trusts or building companies or both?
A little bit of both. We're interested in real estate. We've been adding to it because we see it as a good inflation hedge. So you should have good inflation protection there in terms of the value of real estate. And then the valuations are quite attractive because a lot of the stocks have come back on because of the same concerns about the UK domestic outlook in terms of the economic background. So there's been that element of uncertainty which has led the shares to be relatively weak. So good inflation hedge plus an attractive entry point in terms of valuations. Key stocks that we like would be Capital and Counties, which owns the Covent Garden, and actually Shaftesbury as well. We've got a decent position, and there's a proposed merger on the table of those two businesses. Shaftesbury being the operator of much of Carnaby Street and parts of Soho, and we do see the combination of those two would make a very attractive real estate franchise. If they don't combine, separately, they're also very attractive. The likes of Covent Garden actually seeing footfall which is higher than pre-COVID, pre-pandemic. So the fundamentals are actually very strong at the moment. Despite that, the shares have been laggards. They traded a big discount to NAV, and that NAV's had to be haircut over the last couple of years as valuers have taken more cautious assumptions during the lockdown period. So we see that as really attractive. British Land as well as another one that we see as attractive and been adding capital to. It's got some interesting development projects, an interesting pipeline with respect to being able to create value from development, and also trades cheap versus its NAV.
And Shell and BP are two of your biggest holdings. They've obviously done very well for you recently. What are your thoughts on the whole windfall tax? Is that material at all, or is that well in the price now? And what are your thoughts for those stocks going forward?
Yeah, it's not really material for the big oil majors, for BP and Shell. The North Sea is not a huge part of their asset base. Obviously, it won't encourage them to make the North Sea a larger part of their asset base. So we as you'd expect us to say, are not very supportive of the windfall tax. It was clearly largely a political statement. It will probably discourage investment, just at a time when the UK needs to be more self-sufficient in carbon production. So not supportive of it. It doesn't have a major impact on Shell and BP. We do actually have quite material positions in Harbour and some other E&P stocks which have been more impacted. Harbour's share price is down over 20%. Since the announcement. We see that as an overreaction because there are things that Harbour can do. It has got an investment program lined up, and that will be able to offset some of the tax hit. And there's probably, as well as organic investment, there's probably an opportunity for further inorganic, so consolidation of the producers in the North Sea to offset some of those tax pressures. So we do see it as an opportunity that significant drawdown in the Harbour share price to add to our positions.
And what are your thoughts for the overall market outlook from here?
Well, we've been pretty bullish, I suppose. We're bullish because starting valuations are very modest. UK market trading on less than 11 times earnings. and our portfolio trading at a discount to that. So we're trading on sort of, probably 10 times earnings. We're trading on a price to book of 1.3 times, high free cash flow yield. So attractive starting valuations, and then the portfolio we have should be able to, grow profits and cash flow at a robust pace over the next, 2 to 5 years. So low starting valuation, and attractive medium-term growth. We're exposed to a lot of classic recovery type stocks where profitability is not at peak; it's still quite depressed and recovering. So there's that element to come through. I mean, obviously, it is an uncertain time, and that uncertainty is not going to go away tomorrow. Would see probably the key catalyst to reduce. To temper some of that uncertainty would be, in short-term inflation numbers peaking. Don't quite know when that will be. Probably some point in, through the second half of the year, we'll see a peaking in short-term inflation numbers, and I think that would act as a catalyst for some, reduced uncertainty and for equities to rally in that context. I mean, we've, as a value and recovery manager, we've been relatively defensive in, this drawdown period. Clearly, longer duration type investments, growth investments have been more aggressively impacted. Small and mid cap have also been weak. We have actually, there are some quality stocks that may have been derated too aggressively. So we've been looking to add capital to some of those. Likewise, small and mid caps have been very weak, and we see that as an opportunity to add capital. So all in, we're pretty optimistic about attractive equity returns over the medium term from here.
That's been really interesting, Hugh. Thank you very much for sharing your thoughts today.
Great, thanks for your questions, James.
And if you'd like to learn more about the River and Mercantile UK Recovery Fund, please visit chelseafs.co.uk.